All right, guys. Well, let's get started here. So make this a quick little presentation here on self-storage, and why we like self-storage so much. So thanks everybody for joining. I'm Tate Duryea, CEO of Turbine Capital, and we're here to talk about self-storage today, which is a so let's jump in here. So we're not only going to be talking about self-storage today, but also a case study of a deal that we bought last summer, 4 facilities, 2 markets, a nice high occupancy in Texas. This was 4 facilities for $8 million that we were a capital partner on. And so we'll dive into a little case study on that as well. And let me just make sure that this is working okay, and that we don't have any technical difficulties before we dive in here. All right, so here we go. So there are more self-storage facilities in the US than Starbucks, McDonald's, and Burger King combined. Let that sink in. Americans love their storage. We've got way too much stuff. In fact, if you added up all the Starbucks, McDonald's, Burger Kings, Dunkin' Donuts, Pizza Hut, and Wendy's, you'd still come out with more storage facilities in the US than fast food restaurants. So before we dive into why we love this asset class so much and why I'm personally investing in this stuff, quick little background on Turbine Capital. So we do passive income for pilots. Turbine Capital, just to give a little background on the company, it's an investment company that empowers pilots to establish cash flow and build multi-generational wealth through high yield commercial real estate. We encourage pilots and whoever else, we're certainly not limited to pilots, that's just sort of our audience, to go beyond their 401ks, beyond their retirement accounts, and build current cash flow today in order to supplement their income or even replace it if they choose. So a little bit of background on myself. I'm about a 12,000 hour airline pilot. And I started investing in real estate about a decade ago. This is the first house that I bought, a rental property in Las Vegas, when I was, about 24, 25. And since then I've traded up to some commercial properties, and I've always been obsessed with this idea of passive income, creating passive cash flow to supplement my lifestyle. And as I've grown, I've started transitioning more into commercial real estate, and I've developed a little bit of a passion to help other airline pilots along the way. And I've been modeling my business after some physicians who do the same thing for doctor groups, and nobody was bringing it to the airline pilot community. So that's who we are. When I say commercial real estate, quickly, let's sort of like lay the groundwork here. What is commercial real estate? So commercial real estate encompasses multifamily, office, retail, industrial, hospitality, self-storage, senior living, maybe a few more, give or take. But typically when people think commercial real estate, they think, an office building. Well, yeah, that's true, but it also encompasses all these things. So multifamily, anything more than 4 units is going to be commercial real estate. Anything less than 4 on a tax parcel is going to be multifamily. So I personally started sort of veering up into the commercial realm. This is a property that I bought in South Carolina. I personally own it. It's cash flowing wonderfully. But as I started growing in my investing career, I started realizing that there was all this opportunity in passive investments. So if you've ever heard of investing in real estate with other people's money, this simply is being the money partner. So instead of me going out and borrowing money from people, the bank, investors, whoever, and going out and buying this property in South Carolina, instead, I would just be either a debt partner or an equity partner in someone else's deal, and they're going out doing all the work and taking a small fraction of the profits for doing all that work. And this was a model that was really attractive to a W-2 professional who already has a job and isn't trying to create another one. So some of the other benefits about investing passively is you get institutional grade experience. And while, I have really enjoyed learning how to go and renovate something like this from 6 time zones away, I just can't compete with this particular operating partner who we're going to do this case study on this deal. has 48 employees. They're a team, they're a powerhouse, and they handle the acquisition, the syndication, the property management, asset management, development, and the business intelligence at a level and scale that an individual investor just really can't compete with. So it was a little bit of a, if you can't beat them, join them moment for me when I started investing passively. And so this is the syndication structure. This is what it looks like when you invest in a syndication. So to quickly, again, just lay the groundwork for what we're talking about in self-storage, syndication structure can have to do with any real estate asset purchase, whether it's self-storage, multifamily, mobile home park, senior living, whatever it may be. But the general partners are the team, right? The people putting the deal together. They're the ones finding it, operating it, executing the business plan, getting the financing, doing all this stuff. Limited partners is simply the money partners. And where Turbine Capital fits into this is we are a limited partner. We're simply a group of these people who band together and invest as one large entity. And because we are investing with a larger sum of money, we can negotiate better terms between us and the general partners by having a different share class and better equity split between the general partner, better profit split, right, between the general partner and the limited partners. So anyway, now that the groundwork is sort of laid and we understand the difference between active, passive investing, the different asset classes, let's jump into why it is that Turbine Capital, we've been so focused on self-storage for the last year. So since the beginning of this business, when we launched, we sort of looked at the landscape of all the asset classes that were out there. And during COVID, this business launched last summer. And when we're looking at the landscape and COVID and some of the uncertainties in the market, we found that self-storage had the best asymmetric risk return profile, meaning that it had the most upside potential with the least amount of downside risk. When the economy doesn't do all that well, self-storage tends to perform very well. So without further ado, we've sort of focused on this asset class so far in the business, and that investment thesis hasn't really changed to date. That being said, we will be pursuing other asset classes in the future as opportunities, start to present themselves and market cycles mature. But as of right now, we just love this asset class. So this is what the presentation is all about. So let's jump into it. So as Marie Kondo would say, if it doesn't spark joy, put it in self-storage on autopay. If you don't know who Marie Kondo is, she has a Netflix series about tidying up. This is how sick Americans are. They have so much junk that they need a reality TV show where it helps them get rid of all their excess crap. But most people don't get rid of it. They put it in self-storage. It's the $39 billion annual industry. For every 100 people, if you have 100 people in a room, you've got 540 square feet of storage demand, 5.4 square feet per person. Almost 10% of every household rents a storage unit at a cost of about $88 a month. There is a ton of money pouring into storage right now. Bill Gates, on the article on the left, Q4 of last year, Bill Gates backed StorageMart. Public Storage buys their competitor Easy Storage over on the East Coast for $1.8 billion. And most notably here, Blackstone buys simply self-storage. So huge institutional firms moving into the self-storage sector. There's a lot of money chasing storage assets. So the sector has been recession resistant because it's based on life events. And this is one of the things that I personally love about the storage sector is that it's not market tied to the market, right? If the economy goes off a cliff and the stock market tanks, storage does well. Whenever there's job loss, relocations, downsizing, people moving in with friends, family, they need places to put their stuff. During the Great Recession, storage was one of the least foreclosed real estate sectors, from Brian Samosa. And if you look at a chart of how the REITs have done since 1994, storage has outperformed all the other REITs by over 300%. And in the downturn, it did the least bad, even in a financial crisis. So self-storage uses, what do people use it for, right? And a lot of people think like, well, is it just people with too much stuff? Well, yeah, but there's also A huge array of uses for it. Local businesses, contractors, Etsy, Amazon. We've got logistics companies. We've got landscapers, distributors, college students. And then obviously, you know, the relocation stuff, the retirees, downsizing. We've got a little league baseball team that rents, divorce, seasonal equipment, vehicles, all sorts of stuff. We, one of the properties we are invested in, the Chamber of Commerce rents a spot from us. So why invest in storage? Well, it's easy. No toilets, cabinets, appliances, countertops, super low maintenance. It's easy to evict, highly automated, and very simple. We all get into real estate because it's tax advantaged, right? So if you look at sort of a comparison between multifamily, single family homes and flips and self-storage, all of them are going to have tax advantage. We've got a little double asterisk there because, you know, flipping can be not so good on the tax side. But of course, if you put yourself in an S corp, you can mitigate some of that. But they're all the same. Hey, multifamily is great. I invest in it too. Fantastic. It's all tax advantage. That's great. Average stay is really about the same. It's very market driven. The average stay in the portfolios that we're invested in are about 58 months. So actually fairly sticky tenants. Economies of scale. Obviously, single family homes are just not scalable. Warren Buffett said I'd buy 30,000 single family homes if I could manage them, but you can't, right? So it's just too hard to manage 30,000 roofs and water heaters and all the maintenance that comes along with that. So multifamily, self-storage both have excellent economies of scale. The automation is where self-storage really tends to start coming out on top, right? Somebody can come in, lease a unit, pull up their phone, put in a credit card, sign a lease agreement right from their phone, get a gate code, and move into their unit without talking to a single person. Rent recapture. Rent recapture is simply the process of recouping rent that hasn't been paid. So if you look at multifamily, while it's a great asset class, certainly invest in it as well, but if you have somebody who's not paying, you're screwed. I mean, in certain states, it could take 6 months just to get an eviction started and up to 12 to get them actually out of the property. You're losing your potential for income at the same time as they're ripping up the unit and squatting on your property. And the laws between landlords and tenants are very skewed towards tenants. Nobody cares about somebody with too much crap. This is a exact excerpt from our operating partner's rental agreement. The first page says notice of lien. By entering into this rental agreement, occupant acknowledges and agrees that pursuant to Colorado law, all of the occupant's stored property is subject to lien in favor of the owner after 30 days. So if you haven't paid after 30 days, we get to auction your shit and recoup the rent that you haven't paid. After 3 days, the facility becomes worthless to you. The gate code shuts off. You get a double lock on your unit. That's why we have 2 lock holes on the doors. So you get a double lock. You can't access the unit. The gate code shuts off, and you're locked out. And after 30 days, we start going through the auction process. The auction is handled by a third-party company that comes in, and they handle all the auctioning off of all the stuff. It's kind of like Storage Wars, but it's not like Storage Wars. It happens online. If you just Google storage auction near me, you can see a bunch of stuff. You can bid on it online, and that's how the operating partner can recoup that lost rent. And then finally, it's super low maintenance. You know, I mean, if you talk about a 10,000 unit portfolio, you can have 10,000 doors and probably have 20 toilets. Versus a multifamily, you're looking at 10,000 doors, you might have 20,000 toilets to take care of. So a lot higher expenses and a lot higher maintenance. Next thing we love about it is it's easy to add value. So are you going to rent a truck and move across town for $10 a month? Probably not. You know, that represents $10 a month at the average of $88 a month represents over a 10% rent bump, right? If you bump rent on a $1,200 apartment by 10%, that's $120 a month rental increase. And someone will probably consider, leaving after their lease is terminated and moving somewhere else for that. No one is going to clean out their storage room and move their stuff across town for $10 a month, especially when they don't expect to stay for more than a few more months. But we all know it ends up being longer than that. Next ways that we can boost rent. We've got 10 different ways here. First one is tenant insurance. So the operating partner that we work with, sophisticated manager of the property, obviously they're going to require tenant insurance. Now, you don't have to buy ours, but it's frictionless, right? You sign up, it says you are required. You can shop around for it if you want to. You're probably going to end up paying around the same. But hey, for $10 a month, you get tenant insurance. We get to keep half of that. So multiplied across thousands of units in a portfolio, extremely quick and easy way to add a ton of revenue. Propane, certainly easy to throw a propane facility on there. Merchandise and sales. Again, this isn't something that's really going to move the needle on the revenue side, but it's just going to make it more convenient. Your storage facility is going to be, the convenient spot to be. Boat, vehicle, and RV storage. There's some great opportunity, actually, if you've seen the portfolio that we're under contract right now and currently open for funding. Some of the expansion potential is in this. When I was in the Southeast touring some of these properties, one of the biggest things that we heard from the on-site managers there were, customers are constantly asking for covered boat and RV parking. Storage auctions. ICE, again, not going to move the needle, but it adds to the convenience factor, why somebody would want to choose your facility over someone else's. PO boxes, very easy to put a ton of PO boxes in a very small area and charge $100 a year, $200 a year for. Our operating partner offers FedEx and UPS drop and notary services at every single one of their locations. Again, adds to the convenience. U-Haul. This is a fun fact. After a string of accidents, U-Haul has stopped renting aircraft. This is an article from The Onion. But this is a real easy one. U-Haul is just a ground lease program. So we have nothing to do with the trucks. We simply keep them on property. U-Haul pays the facility to store the trucks. Basically, we just clean them, hand out the keys. Cell phone towers. There's one in the case study that we're jumping into. Actually, we do have a cell phone tower in that portfolio that produces revenue from leasing the land from us. So what we look for when we're looking for projects to invest in with these types of operators as passive investors is existing facilities with expansion potential and or ground up development. So ground up development, no matter what asset class you're in, has a whole lot more risk profile than buying something that already exists. So really for Turbine Capital, this is the sweet spot. This is what we want. We want to be able to invest in something that has a proven track record, that has in-place cash flow, that's going to cash flow on day one, to bring the execution risk down to nearly zero, because we're simply buying an in-place asset, but we have the market demand is there for expansion so that we can build additional square footage onto the facility and boost revenue even further and boost valuation. So this particular operating partner has an entire business intelligence team that looks at demand, population, saturation, pipeline, job growth, rental rates, all this stuff, right? And this creates a feasibility analysis. And if there's one thing that if you're going to invest in storage that you really, really need to understand is the feasibility analysis, the feasibility report, because you can find a great piece of property and the agent will tell you, oh yeah, this is great. And you hear people are coming, but if you don't have a proper feasibility analysis that can understand, where you really understand what the build permits that are in the pipeline are, what the real population growth is forecasted to be, and what your saturation looks like, what the occupancy of your competitors is, you're going to have a failed business plan. So very, very important. And so we look for operators who have a really robust business intelligence team that is capable of digging really deep into the numbers on this stuff and putting together really comprehensive feasibility analysis to make sure that we're making a good investment in the area and the project. This is sort of where we look, and we've sort of compiled this from a number of different operators. Basically, we took the top 4,500 MSAs in the country, and we looked at net migration numbers, population growth, job growth. You'll notice there's nothing in California, nothing in Detroit because it's dying and the net migration is negative. You need people in order for storage to work, right? So we looked at all these numbers. We sort of boiled them down to our top few hundred favorite metros. And if it's, I don't care how good the deal is, if it's not in a metro that's experiencing net in-migration and job growth and population growth, then we don't want to look at it. So asset and property management, this is the kind of stuff that our operating partner does. And it's, as far as revenue, this is the stuff that they look to increase. The operating expenses, this is the typical stuff that you'd see on your pro forma, and stuff that we dig through when we're looking at potential acquisitions. This particular team has 6 people that look at deals. That's all they do. So again, a little bit of the, if you can't beat them, join them thing, right? Because if you want to go out and buy yourself a self-storage facility, it's pretty hard to compete with a 6-person team that looks at 1,237 deals in 2020, puts in 24 letters of intent, and closes on 9 facilities. They're really doing the work to aggregate what is a good deal and what's not. And this is quite frankly what we have sort of taken a shrug stance and just said, listen, I mean, we can learn how to do this stuff ourselves, or we can take a majority of the profit and put it in the hands of a professional. So another fun fact here is that if Blackstone, Cascade, and a couple of the other REITs that are moving into self-storage right now, if they could buy every single storage facility that transacts in a year, and it would only account for 0.2% of their platform. So there's not that much to go around either. That's the other thing. In multifamily, if you want to place $100 million of capital, it's pretty easy. I mean, you can put that in a couple of garden style apartments in Texas. It's really hard to place that kind of money in storage. So there just isn't that much value, to go around. And so there's a lot of crummy deals out there. So there's a lot of aggregation that has to happen to go and find properties like this, the one that we invested in last summer, and we're really, really pleased with the results. So we're jumping kind of now from why we like it so much into this case study of the Tyler Longview portfolio, which is a deal that we bought last summer. We really liked it. This was the first deal that we raised for. And it was a 4-property portfolio. 2 were in Longview and 2 were in Tyler. It's an $8 million purchase price, $560,000 of net operating income. Bought it in September 2020. And the reasons why we liked it: day one cash flow, right? Existing facilities already had good occupancy, just the operation needed to be cleaned up. Low REIT presence. So we like to see that our operating partner is going to be the most sophisticated operator in the market. We don't want to be competing with a bunch of Publix and CubeSmarts because they just have deeper pockets, and there's no reason to compete with those guys. High occupancy, so 90.3% physical occupancy at purchase. Out-of-state owner, guy was not paying attention, had his foot off the gas. There were about 150 out of the 1,500 or so units that didn't even have paper leases. They were just handshake agreements. The people brought cash down. Value add expansion, plenty of vacant land that were attached to the parcels for value add expansion, and economies of scale. This operating partner already had a great, well-paid regional manager that was in the area that could take care of staff training and the transition. So sources and uses. How do we take this thing down? So it's an $8 million property, right? Got Got 5.7 million in a life insurance loan, 1.3 million from private investors for the construction, for the expansion, and then 4 million in equity. So Turbine Capital was we pooled investor funds, and we were just shy of $1 million of that 4 million in equity. So we own just under a quarter of this project. So total capital stack was $11 million. And again, you go out and buy an $8 million property. You don't just need 8 million. You need more than that. So how was this 11 million used? Well, $8 million was for the purchase, 1.3 for the proposed expansion, $1 million worth of improvements. And this was just for roofs, drive aisles, painting, call centers, cameras, just things that needed to be fixed. 300 grand in operating reserves and 400,000 in fees, just sponsorship fees, closing costs, all that stuff. And these were, So where did all this money come from? Right. So we had the 4 million in equity from private investors, including ourselves. And these investors, including us, got a 7% preferred return. And a preferred return, real quick, if you don't know what a preferred return is, it means that, so we're going to split the profits with this operating partner, right? They're doing all the work. So the investors are going to get a split of those profits, but only after the investors have made a 7% return on their money, annualized rolling basis, right? So we have to get a rolling cumulative 7% return on our money before we start splitting those profits with the operating partner. So the way it was underwritten, it was projected to be a 17.9% target annualized return. And this is at the end, right? So we're going to get some cash flow through operations during the hold years. And then at the end, we get sort of the big check, right? When the property sells. If you take all those returns, so the cash flow during those hold years plus the sale, and then you average them over that return, that total return over 5 years ends up being about just shy of 18% per year. So ends up being just shy of a 2x equity multiple, right? Just shy of doubling our money in the projected 5-year hold. So where does the construction debt come from? That's going to come from private investor debt. So this operating partner has a list of investors with appetite for debt. These are the terms that they pay. This is their standard debt term. It's a first position lien. There's some of the property that wasn't collateralized by the life insurance company. And so they were in first position to secure their debt. 1 point paid at closing, 7% paid monthly. And then obviously the bank loan came from a life insurance company, 57% leverage at a 3.75% interest rate and a 25-year AM. So a market rent comparison. So when we look at, once we went under contract on this thing, we're in the due diligence period, right? And we're looking at a market analysis of the rents in the Tyler Longview market versus where, our property sits in that, right? And we knew that we weren't going to be a Class A facility. We wanted to bring these up from about a Class C to a Class B. And what I mean there is just not like a beautiful, brand new, gorgeous facility. It's like just nice, right? So Class A in the market was getting, top end rent. Class B is what we strive to be. And this is the Attic and Highway 155 in Tyler, and the gaps between market rent for a Class B facility and what they were getting. And in Longview, the two facilities there, Gilmer Road and Metro Self-Storage, the gaps between what these facilities were getting and what the market should be. So obviously the owner had really neglected to raise rents to keep up with the competitors. As far as market occupancy, what were the competitors getting in terms of occupancy? Really, really good. 90% occupancy in Longview, 95% occupancy in the market. The portfolio was currently sitting at 91% in Tyler, and the market was 92%. So under market occupancy, that's great. That means there's demand in the market. So what happened after we bought the property? So this is where we currently sit. What are we, 8-9 months after purchase? We're now down at 81% occupancy. So whoa, you guys lost occupancy. What happened? Well, of course we did, right? We went in there and we ruffled feathers. And this is physical occupancy, right? Not economic occupancy. And the economic occupancy is what's important. You can have 100% physical occupancy, but if 10% aren't paying, and the rest are late all the time or want to bring cash down to the office, it's a mess, right? We don't take cash. So when we took over the facility, increased the level of sophistication, we started cleaning up the property and kicking out delinquent tenants. And so, of course, our physical occupancy has dropped, and we expect to see that start to climb in the next 6 months to a year. So again, the feasibility study, and this is just kind of what the computer spits out. We determined that there was unmet demand in most of the markets except for Highway 155. So Metro, Gilmer, Attic looked like had a ton of unmet demand, and this has proven itself, especially over at the Attic. There's just a ton of unmet demand. So really good numbers there. We really like the numbers. Then we looked at population, like the numbers on population growth, and we like the numbers on employment growth. That all gave us the green light to say, yep, let's go ahead and invest in this thing. So we invested in it, operating partner took it under contract, and the contract terms were $8 million purchase price, 42-day due diligence period, and they put $75,000 in earnest money down. And we took it down, we bought it. So during due diligence, we found that it was sitting at that 90% occupancy, 17% of the customers were delinquent. And we love that because we have about 3% delinquency now. So a lot of room to improve operations and get this thing operating like it should be. Between the delinquent customers and the rents that were below market, we found that we had a 30% below market rent collection potential, right? So we could, by bringing up delinquency and bringing up the unit price up to market, we could bring that the income up by 36% just there. The market's at 90% plus occupancy. So we found that we had a $400,000 NOI potential increase, which equated to a $6 million increase in value that we could inject into this property. On the physical side, we found failing roofs, outdated retail offices. There were cats living in some, and it smelled like urine. Old swing doors on one of the facilities, and in Texas it's real windy, so those swing doors tend to swing around and bang vehicles and things. So those needed to go. Those needed to be replaced with roll-ups. Faulty drive aisles, vacant land to expand, and all in all, needed about $1 million to make all this happen. So the rent roll analysis, rent roll is just a snapshot of what tenants are paying. So we found in there that we had a $447,000 per year gap between current collections and market potential. So we could increase income by $447,000 a year between where it was sitting during due diligence and where we thought the market could take it. As far as the vacant land, it included 3 vacant parcels, one at the Attic, one at Gilmer Road, and one at Metro. So the Metro self-storage, and real quick, we didn't have enough time during due diligence to figure out what we could do on all 3 of these. There just wasn't enough time, 42-day due diligence period. So the ones at Gilmer Road and Attic, we just left, and Metro, we went ahead and included the expansion at Metro. We went ahead and planned that, but the projections that, that 17% projected, 17.9% projected annualized return to investors is not inclusive of the Attic expansion or of Gilmer Road, because there just wasn't enough time to figure that out and put it into the projections. But we went ahead with the Metro self-storage expansion, or I should say our operating partner did. We were a little bit involved in what they were doing while they were doing this. They went ahead and said, okay, so what's our unit mix? What's the plan? Decided on a 25,000 square foot expansion in this nice flat graded area. Super minimal construction, slab on grade, single story, very minimal utility, non-climate controlled, the most basic construction build you can do in storage. Needed about $1.3 million to make that happen. If you're doing math, it's about $52 a square foot. And we gave ourselves 6 months to build it and 20 months of lease up time. So from purchase, we gave ourselves 2 years to deliver on this. And we calculated that we could add about $108,000 a year in net operating income. So net operating income being income minus expenses. We're going to add 108 grand per year to the portfolio. After it's stabilized, that would equate to about a $1.7 million terminal valuation of that expansion. So as far as the underwriting went, and underwriting, if you're not familiar with the term, just means, the numbers, the spreadsheet, right? Hey, what do the projections look like? So it was conservatively underwritten to increase collections $403,000 per year over 60 months. So we found that $447,000 was what we thought we could increase by. We just said, hey, let's cap that at $403,000, and we're just going to say this is what we think we can get, and we're going to do it over the entire 5-year period. We gave no value to the 2 vacant parcels that we didn't plan expansions on. So no development on there, and that's just going to be additional upside. If we end up expanding on those. We wrote an expanding or worsening cap rate. So if you're not familiar with cap rate, basically commercial property trades on a multiple of income. So how many times income, very much like a PE ratio in a stock, how many times income are people willing to pay for this asset? And so if the cap rate is compressing like it is in today's market with all this money flowing into storage, that means that people are going to be willing to pay more for a specific stream of income. And but in an effort to be conservative, we underwrote the property to have an expanding cap rate of 6.9% at exit, which quite frankly in today's market is just ridiculous. I mean, this portfolio would trade at about a 4% cap rate at this time. As I mentioned, no value on the 2 vacant parcels, which was nice for us to see. The sponsors not being too aggressive on all the pie in the sky ideas that they have with the property. It's like, hey, we know we're just going to do this one, and if we do more, that's gravy on everything. We got the planned 25,000 square foot expansion at Metro, and we planned for heavy customer friction during the transition rent increases. So we planned for a big dip in vacancy and economic occupancy. And we planned for a 5-year hold. So what happened here? Bought the property, and let's take a look at how this affects you as an investor, right? So this is on a $50,000 investment. And we get a K1 at the end of the year. We provide our investors a K1. We try to do it by about April 1st. Ends up being pretty late because we have to get the K1s from the operator and then break them up into all the investors. And usually we show a loss in year 1 due to depreciation. So we get cash in hand, but depreciation and a loss for tax purposes, right? So on a $50,000 investment, we got a $10,222 loss that we got to use to offset either other passive income or future passive income from this deal. So the losses shield taxable income from the distributions. And yes, you do have to pay recapture upon sale because you're going to have a gain when we eventually sell this thing, but it's at a flat 25%. And with that being said, that's just friendly advice. Consult your CPA. So how does this work? How do we get cash in hand? Like, how do we actually get cash distributions? We ended up with $409 this year in cash actually distributed from the property on a $50,000 investment, but we showed a $10,000 loss. How does that work? Well, it's through depreciation. So we do a cost segregation on the property. So what a cost segregation is an assessor comes out and they determine, hey, what's the value of the land? Because you can't depreciate land, but you can depreciate the structures on the land, right? And commercial property depreciates out to over 39 years. So the assessor is going to come out and say, okay, what of all this stuff can we break into 5-year property? So that would be, chairs, landscaping. If you're in a multifamily, it'd be the appliances. So that 5-year depreciation ends up being $644,000 worth of value, or were the things that were broken out of that $8 million purchase price, where they said, okay, $644,000 worth of stuff on this land should be depreciated on a 5-year schedule. The same thing goes for 15-year property, right? And you run the 15-year property on a depreciation scale, and we got almost $1 million in 15-year, and then the rest of it gets depreciated normally on that 39-year time horizon, right? Because of bonus depreciation, and remember, bonus depreciation is from the Trump, Tax Cut and Jobs Act in 2017. We get to take bonus depreciation on the 5-year and 15-year property. So when you add those up, we got a $1,566,000 bonus depreciation in year one. So this phantom loss, right? You add the bonus depreciation up with 1/39th of the rest of the property, which is 144. And we got a total depreciation expense for year one on this of 1.7 million. So 1.7 million in the first year, and then every subsequent year we'll be able to take 144,000 in depreciation. And again, cash in hand, and then that depreciation expense can offset that by actually showing a loss on our K1s. So that's how the taxes kind of work. The next thing that came along on this deal was we're cooking along and an opportunity popped up. This was to buy a 5th property in Longview. It's called I-20. Purchase price, they negotiated it for 1.8 million. And again, this isn't something that I or you or a couple of us could have gone out and bought. I mean, there were 25 offers on this property, something like that. And they were able to negotiate this because of their reputation and how sophisticated they are. So put it under contract for, I think, 1.9, and then retraded it down to 1.8. It's called I-20 Ranch Stores. Extremely poorly operated. They bought it a few years ago, let their kid run it. He just played PlayStation for a few years, and it's now at 45% occupancy. And if you remember, the market occupancy in Longview was either 90 or 95%. So absolute complete operational turnaround, fantastic property, vacant land for expansion. We love that. 20,000 vehicles per day right on this I-20 corridor. Awesome purchase. And we already have the economies of scale, right? We've already got the staff. We've already got the regional manager, everyone in place, right? Calculated that this could add 182,000 of annual net operating income to the portfolio. And at stabilization, it would add about $3.2 million of value to the portfolio. So acquisition, how are we going to take this thing down? Do we pop up another offering? Do we put it in the portfolio? Well, we had already, of that 447,000 of net operating increase that we're planning on for the portfolio, we're already at 200,000 of that collection strategy. So the portfolio is currently exceeding projections by $30,000 a month. So we just decided to use that additional cash flow to pay for additional private debt to acquire the facility. It's a very simple private debt, no bank loans, no nothing. So did a portfolio loan. The portfolio loan was at a loan to cost of 57%. So plenty of equity. We used the debt to buy the 5th property. The loan cost increased to 66%. So still very, very not aggressive loan to value and loan to cost terms. Raised private debt with a $2.2 million offering. Interest only for 14 months. At the end of 14 months, we will, or maybe even sooner, we'll refinance into more permanent financing. We'll have an extension option of 1%. The debt service cover ratio is 1.5. And if everybody's familiar with that number, that's a real nice number. The interest rate 7% paid to private investors monthly via ACH. So they raised that money and we bought it. Didn't require any dilution of equity from our current investors or any capital calls, just because of the financial strength of the portfolio. And we were able to just add this property straight in using the additional cash flows that were already coming off of it to fund the acquisition. So remember, we started with a 4-property portfolio for $8 million. What's it look like now? This is now a 5-property portfolio for 9.8 million because we added 1.8 million in as that purchase price. So what happened to the sources and uses? We had 11 million to purchase this thing originally. So instead of 5.7 million, now we've got 7.9 million. Instead of 11, we're sitting at 13.2 as a total project cost. $8 million purchase price turned to a 9.8 million. We needed some expansion budget, 200,000 in expansion. So 1 million turned into 1.2. We kept an additional 100,000 in operating reserves, and there were some fees associated with purchasing it. So another 100K there. So assumptions for underwriting. It's a 51.3% expense ratio, which is fairly high for self-storage. So we like to see that. That means it's conservative. We underwrote 91% max economic occupancy, which is nice. That's good and conservative. They're not going around saying like, oh yeah, this thing's going to be 100% occupied. That never happens. We only underwrote 25,000 feet of expansion, and it looks like we're going to have significantly more. A nice conservative exit cap of 6.9, which a year later looks even more ludicrous than it did a year ago, and a 5-year hold. So the original plan, let's kind of compare like what we had planned and where we're going and how we're currently doing. So the original plan was to bump NOI, the existing NOI, I'm sorry, was 560,000. We're going to increase that by 403, not 447, right? Just 403 by month 60. So we gave ourselves 5 years to do that. We were going to add 108,000 per year by expanding at Metro. And we put no value on the 2 vacant parcels. So that was going to add about 1.07 million in net operating income, or about $15 million of valuation. Actually, I'm sorry. That's what we were planning on not adding, but that was going to be the end result. That's at a 6.9% cap rate. Currently, we're at 560,000 of NOI. We've already completed 208,000 in net operating income increase, and we're on month 8. So we're halfway through our business plan already on month 8 instead of month 60. We're still going to expand Metro. Still no value put on those vacant land parcels. However, there's some pretty exciting stuff in the pipeline there. We added I-20, which is new. That was never in the original pro forma. So that is adding 183,000 net operating income from the potential from that acquisition. And so this is what we're looking at today, 8 months into the purchase. So we're sitting on about 1.06 million net operating income and a current market value of 15.3 million. That's at the 6.9 cap, which at current market conditions, which are probably even lower than this, but at a 5.9 cap, we're sitting at almost 20 million in valuation. So what does this look like in terms of investor perspective? Like, okay, so what, right? If we look at revenue, expenses, and just sort of the dashed line is pro forma and the black line is actual. This is really the one that everybody cares about, is distributions. Hey, what's in it for me, right? How does it affect my bank account? Well, this is the pro forma. In year 1, we were supposed to be at sub $100 per month in distributions, and we're far exceeding that. So we were supposed to be cash flowing about 2 or 3% in year 1, and you can see right now we're cash flowing at 9%. So we're doing 9% annualized cash flowing monthly, which is really nice. So we're really enjoying this acquisition. So just to wrap up, how did we all add value? How did our operating partner add value? Well, we didn't do a thing, right? We sat back and worked our W-2 jobs and hung out, and our operating partner went out and they were a better operator, did better marketing, brand awareness, manager training, uniforms, renovated offices. There's no more cats or animals in there. And, everybody's required to put a credit card on file, and it goes on auto pay. All the gates have been put in, automatic gates and lights and cameras and all sorts of nice stuff to bring up the value of the facilities and make it a nicer experience for the tenants. So that is just a little case study of what we invested in last year and how it's going. Obviously, we're very pleased with how it's going, and we're looking forward to finding more stuff like this because it's just fantastic. The downside risk, we think, is very asymmetrically low with the amount of upside that's there. So love to invite you to join our Investor Alliance. You can sign up at turbinecap.com. Just go up to the upper right, hit join, and throw in your info. You'll be the first to know about upcoming opportunities that we're looking at. And speaking of, we currently have a portfolio that's open for funding. This Southeast portfolio is a gem. I had the opportunity in April to fly with our operating partner around Cessna, and we checked out every single one of these. Walked all the units, walked all the properties, talked to the on-site managers, and it's one that I'm really excited about, and one that we're really confident in the partner's ability to add value, just like they did on that last deal. So, in any case, hope you guys have enjoyed. This is the reason why we love self-storage so much, and I guess I'll open the chat box up to any questions if anybody has. But otherwise, thanks for joining us, and if you've registered, you can expect a recording. Thanks, guys.